Hey, welcome back. It's Nolan Mathias, and today we're discussing whether or not you should refinance into a lower interest rate because we're seeing a lot of people out there getting a lot of misinformation and a lot of people doing the calculations wrong. So we want to get into it and discuss exactly what you need to know and set the record straight so that you can make an informed decision on whether or not you should refinance into a lower interest rate. But before we get into it, do me that favor, hit that subscribe button, hit that notification button, please hit that like button so more people like you can see this video, and don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their mortgage or rent payment for a month just for subscribing to this channel. So go ahead, hit that subscribe button. It's free and it's definitely worth it. Okay, so let's get into it. Let's discuss whether or not you should refinance into a lower interest rate because this is a complicated subject. In fact, it's a subject that we see bankers and mortgage brokers get wrong pretty often. And we want to make sure that you are getting the right information when it comes to refinancing into a lower rate. So let's start very quickly with variable rates. With variable rates where you have a 3-month interest penalty, if you can get a bigger discount and a lower rate, it almost always makes sense to refinance into a lower rate. Now, sometimes you have something like a bona fide sale clause if you got a discount mortgage, or you have some sort of weird penalty calculation if you got a mortgage from a fringe lender. But for the most part, if you've got a variable rate mortgage in Canada, you're going to have a 3-month interest penalty. And if you can get a lower interest rate, it almost always makes sense to take a lower interest rate and refinance and pay that penalty. So let's start with that and say variable rates almost all the time. If you can get a lower rate, it makes sense to refinance that variable. Okay, so now let's talk about 5-year fixed mortgages because for the most part in Canada right now, it is pretty hard to find a 5-year fixed where it makes sense to refinance into a lower interest rate. And we're going to give you some pretty tried and tested rules to figure out whether or not it makes sense. Now, I've got some bad news for you. If you've taken a 5-year fixed rate, whether it's with a monoline lender or a bank, it's probably going to be hard to find a rate that is good enough for it to make sense for you to pay the penalty and get a lower rate, unless you're in the last year to 2 years of your mortgage term. Now, if you're in the last year or two, often it makes sense, but outside of that, it becomes really hard. But that doesn't mean that you shouldn't try. Definitely run the numbers, but I'm going to forewarn you right now that if you have a 5-year fixed mortgage and you are only 1 or 2 or 3 years into it, it's going to be very hard to find a circumstance where you can refinance into a lower rate and save a significant amount of money. Now, that being said, if you've got a mortgage with a smaller lender, a monoline like MCAP, First National, CMLS, Merix, it's going to be significantly easier than if you got a mortgage at a big bank. Big banks have both an interest rate differential and they have an added discount, which is the discount that they gave you off of their posted rate at the time that you got the mortgage, which makes the penalties tend to be even bigger than what they would be at a monoline lender or a lender who specializes in mortgages. So if you've got a big bank mortgage, the chances of you running these calculations and getting a number that makes sense for you to refinance into a lower rate are actually going to be very, very slim to none. It's very difficult to take a big bank mortgage and move it to a different product and get a lower rate. So I'm going to forewarn you on that. Again, still make sure that you run the numbers, but that's the hard part in this whole situation is if you've got that big bank 5-year fixed, you're probably stuck. Now, there's 2 parts when it comes to determining whether or not you should refinance into a lower rate. The first is getting what your payout penalty is from your lender, and the second is to actually run the numbers and do the calculations. Now, as far as getting the payout penalty from your lender, I highly recommend that you call your lender and get it directly from them. Understand that payout penalties move quite frequently, so when you start this process to when you finish it, that payout penalty could change, but definitely phone them or see them in person if that's possible in order to get the actual payout penalty, because what we find is that the payout penalty calculators are often confusing, and as a result, we see people coming in thinking that their payout penalty is going to be $2,100 or $2,200 and it's actually closer to $10,000 or $12,000. So you want to get that number directly from the source or have somebody like us help you figure out what the number will be so that you've got an accurate number to start with. Now, once you've got your payout penalty, the process of figuring out whether or not it saves you money is pretty simple. If you can save more money over the remainder of your term than what it costs you to pay out the mortgage, then it makes sense to refinance into a lower rate. And if you can't save that much money, then it makes sense to stay where you are. Now, the one caveat to this is if you are refinancing to a lower interest rate so you can get a lower payment so your monthly bills are more manageable, sometimes it makes sense to pay the penalty even if it is a high number, just so that you can have a more manageable day-to-day mortgage payment in your personal finances. But outside of that, if you're looking purely for a savings perspective, then the number is really simple to calculate. It is simply how much am I saving versus what is my penalty. Now, for illustration purposes, I'm going to use a $100,000 mortgage and I'm going to use really simple interest rates. I'm going to assume that we're taking a mortgage and we're lowering it from 3.5% down to 1.5%. And The reason I'm going to use simple numbers is so that we can pretty much show you how to do this math in your head, and then also show you how it looks in a calculator that you would get from a more typical mortgage broker. So if we've got a $100,000 mortgage and we're going to assume that we have 4 years left on the mortgage, and we are reducing the rate by 2%, the math, it should be pretty easy to do in your head, right? You got $100,000, you're going to save 2%, so that's $2,000 a year. Over 4 years, you're going to save about $8,000. And that's pretty close to accurate. You're going to save actually a little bit less than that, because obviously as the 4 years passes, you're going to pay off your mortgage a little bit, and the amount of interest that you save is actually going to be slightly smaller than that, because each consecutive month, the amount that you owe is going down. However, it's pretty close, because when you look at this calculation for a $100,000 mortgage and you assume that you are going to take the lower payments, the savings on interest ends up being about $7,594.85. So real quickly, if you were to call up your lender and say, hey, what's my payout penalty? If they said it was $10,000, then you know instantaneously that it doesn't make sense to do this. If they say it's $4,000 or $5,000 and you know that you're going to save $8,000, then yes, it absolutely makes sense to do it. Now, one thing that we see quite frequently is people getting these calculations wrong and basically doubling up on the savings and thinking that they're actually going to save more than they do. Because if you look at the base scenario versus scenario 2, there's 2 places where the savings are obvious, right? It seems like the term interest is significantly less in scenario 2, and it also seems like the balance remaining is significantly less in scenario 2. But what you'll notice is if you look at the difference between the interest and the difference in the balance remaining, the difference is actually fairly similar, and that is because in this scenario we have kept the payments roughly the same at around $500 on that original $100,000 mortgage, and therefore the savings is being applied to the principal. So the interest savings pretty much matches the reduction in the balance remaining, and the reason for that is quite simply because we've taken all of the interest savings and we've applied it to the principal. Now, over the weekend, I had a client email me. Actually, he wasn't a client of ours. He was a client of somebody else's. He sent me this exact same scenario comparison for different numbers, obviously. And he said, hey, my broker is saying that I'm saving $7,000 on the interest, and I'm also saving $7,000 on the principal, and therefore I should save a total of $14,000 less my penalty, which is $6,000, so it makes sense to do this, right? And I had to give them the bad news that the broker was inadvertently double counting the amount of interest that he was saving, because he was taking the interest savings, applying it to the principal, and it made it look like there was a double up, but there wasn't. So here's the key thing to remember when you're calculating interest savings, is you can only save the interest once. If you're borrowing $100,000 over 4 years and you were saving 2% a year, you were saving $8,000. That's it. It doesn't matter how much the principal gets paid down or how much lower the payments are, the interest savings is the interest savings. So that leads us to the next piece of the conversation, which is once you know the interest savings, how do you apply it? Well, there's 2 ways that you can apply the interest savings when you are reducing your interest rate. The first is you can take those interest savings and you can apply them completely to the principal. The way that you do this is by keeping your payment the same. If you look at the base scenario versus scenario number 2, the payments are identical. That means that all of the savings is going directly to the principal reduction. Now, the second thing you can do is just take the lower payments. And when you take the lower payments, some of your savings is going towards lower payments, and some of it is going to go towards principal reduction. Because when you look at the base scenario versus scenario 3, where we have elected to take a lower payment on the same amortization, what you'll see is that you save about $100 a month in payments, or $4,800 over the 4 years. And then your principal is also reduced by $2,817, giving you total savings of $7,594.85. Now, why is this slightly less than the second scenario where we're keeping the payment the same? Well, the reason why is when we kept the payment the same, we're obviously paying a little bit more down on our mortgage each month, and that is compounding the savings, making it a slightly better scenario if you're looking from a perspective of pure savings. So again, you can only save the interest once. You want to make sure that you're not double counting it, but the way that you can apply it affects ultimately whether or not it saves you more or less. And obviously, keeping your payment the same has a little bit of a benefit when it comes to interest savings, but it also has a pretty big benefit when it comes to reducing the amount of time that's going to take to pay off your mortgage, because in this scenario, we're reducing the amortization from 25 years down to 19 years and 3 months simply by keeping the same payment. And then as time goes on, that reduction in amortization is going to have a compound effect, and it's going to save you more and more and more and more. But again, the key thing to remember here is that interest can only be saved once. You want to make sure that you aren't double counting it, And make sure that you understand that the math is really simple on this. The amount of interest that you save, if it is greater than the payout penalty, it makes sense to refinance and get a lower interest rate. And if it's not, make sure that you're keeping an eye on it. Make sure that you're always looking to see if there's savings. You can work with a brokerage like ours who monitors this for you. And that brings me to the next point, which is really important. This YouTube channel is brought to you by Mortgage 360, our mortgage brokerage. So if you're in the process of doing something like considering moving to a lower interest rate or purchasing a house, I definitely hope that you would consider choosing Mortgage 360 for your next mortgage, because that will allow me to continue to make these videos and also allow me to get my wife and my business partner to allow me to continue making them as well. So do me that favor, hit that subscribe button if you found this information useful, hit that like button as well, and don't forget about our race to 10,000 subscribers, and we'll see you on the next video. Cheers.